So good morning, everybody. Today's mastermind call is going to be surrounding Delaware Statutory Trusts, or DSTs for short. It's a unique way of actually syndicating funds through 1031, through different 1031 investors can join in on a DST. Ray's definitely more the expert on this. I'm going to go ahead and let him kind of take over the reins. But Ray and I met very briefly at a recent capital raising summit, and I was just blown away with I didn't even know that existed. That like it's sort of like a syndication, but with 1031. So welcome, Ray.
Hey, thanks. Thanks for giving the opportunity, Brandon. Looking forward to explaining a little bit more about the Delaware Statutory Trusts. DST is literally the only syndication that the IRS allows for 1031 exchange investors. DST was created about 15 years ago in response to a lot of the problem tenant and common interests had. And it's really grown in popularity. For example, about 7 or 8 years ago, the DST marketplace was only about $2 billion. This year, it's capped over $12 billion, and it's really growing in popularity. Like I said, the biggest benefit of the DST is the 1031 option. Your typical investor, I find, is a baby boomer or older, someone who is sick and tired of the toilets, the tenants, and the trash. Right? They don't want the headaches. They don't want the hassle of being a landlord. So they will sell the properties, leave active management, 1031 exchange into a Delaware Statutory Trust or a bunch of Delaware Statutory Trusts. Typical structure of the DST is $100,000 minimum investment. It's up to the sponsor company if they want to take less or make it higher, obviously. Benefits of the DST above and beyond the tax deferral is, as I mentioned, you're tired of active management, you want to move to mailbox money. Typically, it's a check paid monthly, or direct deposit, it is 2022, made to the investor on a monthly basis. They participate in any of the tax pass-throughs. They participate in any appreciation when the property is sold. Very, very easy to diversify. An investor, say, if had $1 million, they could, let's say, buy into 5 different investments. They could buy into an Amazon distribution warehouse, for example, maybe a Class A apartment complex, maybe a storage facility. And these places could be all over the country. It's very, very easy, very popular for 1031 investors, especially retirees. A few of the other types of investors, you'll see people who have boot, meaning or money left over in a 1031 exchange transaction. Maybe they sold the property for $10 million. They found another property they love, but it was only $9.5 million. There's $500,000. What do you do with it, right? You're stuck paying taxes on it. So take that $500,000, you can move it into a DST, and they can continue their full tax deferral in their exchange to keep the money working for them. Other options are DSTs also make great backup plans. So people have identified properties in their 1031 exchange and not sure if it's going to go through. As I think we all know, in real estate, sometimes shit happens. Not every deal goes through. But you're past your deadline, you're stuck paying taxes. But if you use some DSTs as backups, you have a place to put the money and not get, killed by Uncle Sam for 35% of your capital gains. As I said, with the Delaware Statutory Trust, I believe, Brandon, I'm talking to a group of syndicators today, right? Not investors. So I'm touching on points. I'm touching on points of why this is attractive to the investor right now. And typically a DST, it needs to be very conservative real estate. There's no capital calls allowed. You can't do substantial modifications to the properties. The IRS has set up a lot of different, I guess you could say, handcuffs. And if you want to Google this, or I could actually pull it up, it's called the 7 Deadly Sins of the DST. And basically what that means is that certain things you cannot do with a DST property to keep it eligible. So if you do break one of these so-called 7 Deadly Sins, it blows up the deal. So it's very important that this is stabilized real estate that doesn't need a lot of work, that is pretty conservative. You you can't do you can't do capital calls, you can't do substantial improvements. You cannot do an equity line on the property. And if you sell the property, you can't buy something else. You have to distribute the proceeds to the investors. Does that make sense?
Mhm.
And I'm happy to, if people want to put questions in their chat, because I know I'm probably going a little bit fast, and there's not a lot of visual aids going on right now. So if I'm confusing people, please stop me and I'll explain something. Another real superpower besides the 1031 exchange and passive nature of the DST is the debt. You can replace debt in a DST. So, for example, as is common with most institutional or professional real estate investors, we all use leverage to buy deals, right? We go buy this multifamily asset and we're using 50%, 40% loan to value with the bank's money. When you do that in a DST structure, it allows the investor to buy into the trust and get their debt replaced. So, for example, if you sold a $2 million property, you had $1 million mortgage on it, right? Under the rules of the 1031 exchange, you have to replace the full $2 million. The IRS doesn't care if you use $1 million cash to replace the debt or if you get another mortgage. Well, the problem with moving from active to passive management is you don't probably want a mortgage to deal with, right? And then how do you do a mortgage in a limited partnership? How do you do a mortgage in a REIT? You cannot do it. You can in a DST. So as I said, the DST is a 50% loan to value. Let's say you bought a $40 million property, you financed 20 million. Well, my scenario with the client who had a $2 million property, sold it, has $1 million in equity. When they put their $1 million in equity into the DST, they're buying in at that 50% loan to value that the DST is at. So hypothetically, their $1 million just bought $2 million of real estate. The beauty of it for the investor is, one, it satisfies the IRS's needs because as they buy into the trust, they're getting the unencumbered shares and the encumbered shares. However, the debt is non-recourse to the investor because the trust has it. The investor gets all the benefits from the IRS standpoint. They get all the additional or new depreciation passed through, any expenses, any points, any types of deduction created from having that mortgage is passed through to the investor. They also get the benefit of, upon sale, right, that a property appreciation value, the bank obviously does not get their, that share of the growth. They just get their money back. The investor participates in that growth. So they kind of get all the benefits of the debt without really having most of the risk, if that makes sense.
Mm-hmm.
So that's really the two most powerful things of the DST are obviously the 1031 exchange and the debt replacement. Or, for example, if someone has an all cash exchange and they're comfortable investing into a DST that has debt, they're going to get all that extra depreciation that they didn't have before, potentially making their income tax free. So there's a lot of benefits to an investor. And why syndicators are doing DSTs is a number of reasons. One, there's two ways to do it. A lot of times a syndicator already owns a property and you're thinking, I've had it for a while, I'd like to divest of this, but I still wouldn't mind managing it or keeping a piece of it. Putting it into a DST is a great way to do that. And not only is it a great way to invest capital, sometimes companies will go acquire a property with the full intent of putting it into a DST. The reason the DSTs are done, there's basically three main reasons. One, it's the quickest way to raise capital. Two, it's the cheapest way to raise capital. And then three, if you preform, you'll have perpetual money coming back into these DSTs. The reason I say it's the quickest way is because your typical investor has 45 days to make up their mind. They cannot think about this for 6 to 9 months. Right? They've got to make a decision. The reason it's a cheap way to raise capital, one, you don't have your money out there for a long time. So if you're using a bridge loan to acquire the property or whatever means of finance, your syndication is not lasting 6 to 9 months. Typically, they usually tend to fill up fairly quickly. That's not always the case. I mean, right now we're having a bit of a slowdown in 1031 exchange volume. But when interest rates calm down a little bit first or second quarter of next year, I think you'll see a little bit more normal transaction activity pick up. And another reason why it is cheaper is typically how the DST is structured is because to satisfy IRS boot rules of, they can't pay all these huge, they can't have all these different fees and stuff picking apart their investment and hurting their 1031 exchange. And so what you do to cover the cost, the commissions to someone like me, who is a DST, salesperson, cover the cost of the attorneys, the tax, tax reserves, a little bit of property reserves. All this is basically passed on through the customer. So for example, how you do this and why it doesn't cost you as a syndicator very much money is, let's say you bought a property for $100 million. In order to cover all these costs, you turn around and syndicate it, that we'll use round numbers here, but let's say $110 million. So when the customer buys in, they put that $1 million into your syndication, it shows that all of their $1 million is being invested in real estate. All the commissions, everything is covered by that markup. Not just commissions, but every other fee associated. DSTs are a little bit more expensive to put together the partnerships because there's a little bit more legal work involved. Obviously, our broker also requires you to do a third-party due diligence report and also get a third-party report from an attorney stating that, yes, in fact, this is actually a DST. We're very thorough with the sponsors we work with and help raise capital for. We work really hard to protect our customers. We're fiduciaries. So basically, quick way to raise capital, a cheaper way to raise capital because the majority of the costs are passed on through to the investors. Also, the nice thing about it is you can keep up to about 5% of the DST yourself as a sponsor if you want to, so you can participate in the deal. You also can, you also can get your property management or asset management fee depending upon your role as a syndicator, how you're controlling the property. I know I've rambled on through a whole lot of stuff, and I'm sure a lot of it maybe just went right over people's heads or in one ear, not the other, but I'm happy to answer questions and get a little bit more into the weeds or explain something a little more clearly.
Yeah, I appreciate you going through that. So what I'm gathering is that it's sort of an all or nothing type structure. It's not where syndicators can partner with a DST to acquire, like for the equity. It would be more of an exit strategy. When you're looking to sell the property, you could potentially sell it into a DST and retain a piece of it.
Correct. And oftentimes if you have a REIT or something 6-7 years later, you can turn around and buy that property back out of the DST if you would like to. You just got to make sure the numbers work for the customers as well, because if they don't have a good experience and don't make money, they're not going to move your capital. They're not going to put their capital back.
And if you retain that interest, that 5%, you could say up to 5%, does that make you the lead tenant or the lead 1031 investor?
No, it doesn't. So you have to have in the DST, there's the trust, and the trust owns the property. The trust has to have what is known as a master tenant, and the master tenant can oftentimes be your own property management company. Sometimes the sponsors will contract maybe with a third party property manager, but it's not like a TIC. There's no voting rights. The asset manager calls the shots.
Okay.
So as an investor, you have no control. But for most people, that's fine because control equals responsibility. Right. They have no responsibility. They've given up control to go into something passive. So the master tenant or asset manager has all the decisions of the property, raising rents, doing whatever, when to sell. They're responsible to control the property, and the investors are along for the ride. And oftentimes the sponsor owns a piece of it, and they also are obviously the asset manager. So they kind of have control anyways, but just because you own 20% of the trust doesn't mean you really could call any shots. If you were, say you were a bigger investor and you bought in a big piece of the property, you don't really have any authority. Okay. It's all managed by the sponsor. And then, it's no different than in a REIT or as a limited partnership. You as a limited partner, you typically don't have any authority to call any shots on that property anyway. So it's not a whole lot different from that standpoint.
The DST comes in to the limited partner LLC, just like every other limited partner. It's just their percentages based off of the amount, just like everybody else.
No, there's no limited partner. It's a DST.
Okay,
Like the limited partner doesn't exist at all. There's no such thing. It's a DST. So you have a partnership, you have a REIT, or you have a DST. It's not, there's no intermingling of that. There's no general partner, there's no limited partner. There's the trust. The trust owns the real estate. You have a master tenant, usually the sponsor company. So you as a syndicator, you're the asset manager, you're controlling the property. All the other investors basically own units of the trust, known as beneficial units of interest in the trust, or simplify it, a shareholder.
but then can a DST invest in a syndication, say a $10 million raise, and you have $1 million DST? Can that participate in that $10 million raise?
No, the DST is the syndication.
Gotcha.
So if you have a, $35 million apartment complex or whatever you may have, the DST takes down the entire property. It is owned by the trust. So this is a whole new way to syndicate. To most people, it's a new way to structure the deal. No limited partner, no general partner. It's the trust owns the real estate. Sometimes it can be multiple properties, but it's typically one. And then the master tenant of the trust will then manage that property.
Gotcha.
How about liquidity for investors?
It's not really very liquid. I mean, it's not a REIT, it's not a mutual fund. They can't keep a bunch of cash other than reserves as required to, to maintain any, property. You do know, as an investor, you do own the units. You can attempt to sell them. And it's really up to the sponsor company. If the sponsor company wants to buy your units, or oftentimes sponsor companies will help you sell your units, but it's not as simple as just calling up your broker and saying, I want my money, or putting a for sale sign. I mean, you are investing in real estate, and the DST does not have as much flexibility as other structures. I mean, there's some trade-offs in the DST because the IRS allows it as 1031 exchange eligible. There's some handcuffs on it. It's got to be real property. It's got to act like real property. So it's not the perfect solution unless you want to do a 1031 exchange. Then it's the only solution.
So when an investor exchanges into a DST, the idea is to stay with them through the full cycle of real estate, whatever it is, ownership.
Yes, correct. And every sponsor company does it different. I would say the average hold time is 5 to 7 years. So the reason for that is there's two restrictions on the DST that make it so that they're not like forever properties. One is you cannot refinance the debt, barring financial catastrophe. There's some parachute clauses that are put into these DSTs to protect the investors at the end of the day, but it just in typical, assuming everything is normal, you can't just refinance the debt. When you get the financing on the property, that's the financing. Typical commercial, real estate loans are typically 10-year balloon payments. So that property's got to be sold before that balloon payment's due. The other thing, even if it's a non-debt, say it's an all cash DST offering, the IRS still has this rule, and I honestly do not understand why, but it's got a 10-year time horizon. So investors aren't going to be stuck in this for 15 to 20 years. And typically with a lot of the assets with multifamily, right, it tends to grow in value. So we want to sell, get our money out of it, get our profit, and then do it again. Sometimes it's a triple net property. If we hold that property too long, there's no way the customers are getting their money out of it, right? Because in a triple net, every year that lease goes down, the property value is just dwindling away.
So are these being done in opportunity zone? It seems like a perfect investment for opportunity zones.
No, that's a completely separate syndication, an opportunity zone syndication.
But DSTs aren't buying in opportunity zones.
No, you can't, because an opportunity zone, in order to qualify, has to be a new development.
Oh,
or a remodel.
a significant remodel. Yeah.
Yeah, and a DST, clearly says you cannot significantly alter the building. So it's kind of the exact opposite.
Yeah, yeah.
Are you allowed to say like renovate 40 of the units?
Yeah, like what counts as significantly?
So you can do, so let's say we buy an apartment complex that was built 5 years ago. You can say, hey, you know, we are going to put in new appliances. We're going to add a dog park. We're going to improve the gym. You could do small modifications, which is very common. You have to raise that capital up front or pay reduced cash flow to the customers to use some of that money to remodel, because you're not allowed to do a capital call. You know, so I tell people a DST is typically class A stabilized real estate. This is not good for value add, for deep value add. It's not good for flippers. It's boring. Most of your investors are going to be older. They're going to be retirees. They want to protect their assets. You have to have low risk property. You don't have to, but our firm isn't going to sell it and we're not going to syndicate it for you. If you want to go and figure this out and do it yourself, you can do whatever you want to try to do with the DST. My broker dealer, Concord Investment Services, of which I'm currently one of the top 5 producers at, we've done over $1 billion in DST syndication this year. If it doesn't fit into these guidelines, you know, good luck to you, because we're not going to consider.
What are
Sorry,
yields
guys.
like? What are yields like for investors? Like, what do investors typically get?
So currently, you got to remember, you got class A, so we're buying newer,
Yeah.
more expensive properties, right? Cash flows are anywhere, apartment cash flows are in the 3s and low 4s right now, net. We do have some deals we get from time to time. We've got some hotels, a few different things that are in the 5s. Those cash flows do tend to go up because if we're managing an apartment complex and you know, for example, not we, but as a syndicator, you're managing this apartment complex, you're raising your rent, right? You're passing those increased rents through to the investor. You know, 3 years ago, you'd ask me that question, I'd say 5 to 7%, but we've seen real estate prices spike and rent hasn't followed it as fast. And then now with interest rates a little bit higher, you know, it's a little hard to get those really crazy good yields.
Yeah.
But, you know, I mean, here's an example. So, you know, we have a few different offerings that are Amazon distribution warehouses, right? I would consider this a pretty conservative, $100 million property with a 20-year Amazon lease. And you show the customer and say, look, the yield's 3.5%. And most people they're going to treat it like a bond. They're going to take that because the tenant's Amazon and they know they're going to get a check every month and it's very, very safe. So the yields are a little lower, but it's class A, it's not class B, it's not class C.
Sure. And one other question, the sponsors or people who are putting this together, they're getting compensated through the management, you know, property management, asset management. They're not getting a promote. I don't know, how do they make money? Yes.
There can be a small promote on the back end of just a few percent. You know, they also, maybe they're getting an acquisition fee.
Okay.
Or maybe you already own the property. Let's say you buy this property for $10 million and now you'd like to sell it for 30. Well, DST is a great way to sell it. So you're gonna make your 20, plus you're gonna have maybe a couple of, you know, point acquisition fee. I mean, if you can kind of charge what you want, but if you charge too much, you're not going to raise any capital. You know, the investors have got to make money too, right? So the reason the company is doing is, one, it does allow them to market up. It's kind of why sometimes while you're syndicating, you're using other people's capital to make money. So if you're keeping 5% of this deal for yourself, you know, maybe you bought the property for less and you're syndicating it, not only for the amount to cover the fees, but maybe you're syndicating it for enough to give yourself a piece of the deal. You know, if you can make the underwriting work, do whatever you want.
Okay, so there's no IRS restrictions, legal restrictions preventing a sponsor from structuring this in some creative way, albeit they have to obviously provide enough yield that investors would be attracted to
Yeah,
us.
but your typical like 80-20 water flow, preferred return doesn't exist.
Sure. Just because
And-
it can't produce the yield to attract invest, is that it, or is it that people don't want to invest in that?
No, I mean, I think the waterfall is very popular personally. I think a lot of people like that structure. The DST is just kind of like, look, the investors are getting the majority of the gains here.
Yeah.
But that's why you as a syndicator, you keep 5% of the deal.
Yeah.
2%, or sometimes syndicators don't keep a piece of the deal at all. But where you kind of make the money is you have to have a more of a longer term vision here, because let's say you buy this property, you're paying a 4% cash flow, and you get that up to 5.5 or something over a few years, right? You turn around, you sell this property in 5 years, you make your investors a 50% capital appreciation on top of their cash flow. And then you say, hey, we're going to go buy this other property about the same time we sell this property. And so when these investors get their money back, well, they're in another 1031 exchange, unless they want to pay the taxes. Where they, and you've performed and done well, and their money was safe, where do you think they're going to put their money?
Right back in.
Right. 95% of DST investors just roll their money back into DSTs.
Sure.
And I'm just telling you from experience, as someone who sells these day to day to the retail customer, is your XYZ apartment company just not did a great job for me. I'm very happy. Just go ahead. Do they have another offering? What is it? Okay, cool. Put the money back there.
Sure.
With them. Doesn't always go that way. Maybe your new offering doesn't work, so they put it with someone else. As a fiduciary, I have to do what's best for the client, but the majority of the time that money is coming back to you. And so this is a perpetual way to raise capital. A lot of these tea companies are doing 5 to 10 offerings a year. Some of them do DSTs to raise capital for the REIT, and then the REIT buys out the clients out of the DST. I mean, there's just a number of ways to do this, but at the end result, it's a fantastic way to raise long-term capital.
So to be accurate to say that each property gets only one DST, but that DST can invest in multiple properties?
No, you look at it the other way around. Excuse me. The DST owns the property. The DST can own multiple properties, but it's a DST. Every DST has its own tax ID. It's a separate entity per every DST. So, for example, Mike, you put together a DST and you go buy 3 apartment complexes and you put them in this DST. That's the DST. If you sell one of those apartments or all of those apartments, the capital goes back to the investors. It's very common though for a DST to be one property. That's probably honestly 3/4 of DSTs are one property.
And properties typically identified then before the DST is put together, or is it almost like a blind fund where you just
No, it's not blind. As an investor, you know exactly. So the benefit of the DST, it's already done. So you as an investor going in, if there's financing, it's in place. The environmental report's been done. The due diligence has been done. The appraisal's been done. The deal's been funded. So the 2 ways people do a DST is option 1. You already own the property. You'd like to divest of it. So let's sell it. Let's re-register it, put it in the DST, and all the capital we raise is us getting our money for selling. The other way is you either acquire the property new or use a bridge loan, which is very common. It's obviously a little bit more expensive to use a bridge loan to acquire the property. And then you're raising then the investors are funding the capital either pay off the bridge loan or pay you back for buying the property.
So from a functional standpoint, where we have this A-class property, we're looking to divest of it. We want to structure it into a DST, being the master tenant. We just call you, and then you would raise the funds and help put it together.
Well, so how it happens is if you have a property identified or that you already own, and you say, hey, I think a DST makes sense. Yes, then call me And if my firm won't do it, I will try and connect you with firms that will. I can't guarantee I can get every deal done, you know, or connect you every single time. And sometimes if we don't like your property, you know, if the property is not a fit, you know, we're no one I know is going to do it.
Gotcha.
Right, it's got to make sense. We also don't want to be sued, right? So we want this property to perform. But if we say, hey, my firm does like it, then we will be the sales force for it.
Okay.
That would just be boom included. Here you go. We're going to put it together, help you put it together, connect you with the right attorneys, help you put it together. And then we're going to go out there and we're going to offer it privately to our customers.
And what's your fee structure for this?
So us if we do it as a syndication, if we're the people putting together, we might ask for a little bit of piece on the back end. We always do the first one free. Kind of like, you know, handing out crack to a first time user once you get hooked, and then we're going to come back and charge it. But we're definitely a lot cheaper than a lot of other what they call a managing broker dealer. We're not trying to make a fortune on the asset management side of these things. We want deal flow. We want to do repeat deals. And that's how our group works. Other groups, they want a separate asset management fee they want to charge. They're going to charge you, you know, there is going to be some cost to you as a syndicator of a couple of points, 1 to 2 points maybe.
And how big are these raises on average?
I would say that the smallest I've really seen equity, probably 15 million. The average is probably 30 million. But I've seen some that were 200 million.
So the average deal size is like $60 million, you know, somewhere in the 50 to $80 million.
No, I'm going to say more like 20 to 40.
But you're raising, okay, 20 to 40. Okay.
Equity. So, I mean, if there's financing on there, right? There's no that.
Well, that's what I mean. The whole deal size is equity plus debt, whatever is going to be.
So what I'm saying deal size, the equity we're raising. So maybe it's a $50 million property, but you borrowed 25 million from the bank. So we're raising 25 million in equity.
Okay, got it.
So you're kind of a cool.
Go ahead.
Another cool thing for the investors. Remember, I talked about kind of that hypothetical sort of 10% markup. If you're using debt, there isn't a markup on that. So if you're 50% loan to value, it's really only about a 5% total fee to the customer, because there's no fees and commissions paid on the money borrowed by the bank, right? So could be, I think, and honestly, most DSTs use debt. There are some cash ones, but debt's a great structure in a DST.
And then is there a time frame for like a 1031 investor then that's going to go into a DST instead, that they have to have a property secured by? Or
well, from the investor point of view, it's the same as any other 1031 exchange. So the DST is identified instead of buying 123 State Street, you know, and you put that on your identification, you're going to put XYZ DST. So, and you can buy, like I said, the investor can buy multiple DSTs. We get all the ins and outs of the 1031 exchanges. I know how to help an investor basically not screw up their 1031 exchange.
Very cool.
So there would still be like a GP team, correct? And no? Okay.
So when you think of DST, forget GPLP. Just forget. This is a different animal. I know it's hard because everybody's so used to this GPLP structure or a REIT structure. It's more similar to a REIT than it is to a partnership.
Okay.
So it's not necessarily a replacement for what you guys are.
So the trust owns the property. The trust is an entity. It's a trust, right? Called a Delaware Statutory Trust. It's a specific type of trust, like there's a living trust or, you know, an AB trust. There's all these different trusts you can do. Well, there's a Delaware Statutory Trust that is created to own real estate. And then inside the trust, you'll have basically the asset manager, the master tenant. Most of the time they're one and the same, but not always. And that would sort of, I guess you could say that's kind of like the general partner,
Okay,
but they're getting compensated differently. They're getting their asset management fee, maybe a very small promote, but it's not like a waterfall. There's no preferred return.
Gabe, you had a question?
So many questions. This is interesting. Ray, what's the path you've seen for apartment investors, and particularly kind of smaller apartment investors that have really started on that 10, 20-year journey to build some momentum with these DSTs? What have you seen from some of your customers?
That build momentum with DSTs. Well, I mean, the typical retail customer is someone who's just owned real estate and they're selling it. You know, maybe they own a duplex, maybe they own 25 residential properties. I don't know, maybe they own some commercial properties. I will say that you have to be an accredited investor to invest in these. They are regulated by the SEC and FINRA. Accredited investor is $1 million net worth, in case somebody on the call doesn't know. So I would say the typical answer your question. I mean, you've just got people who've owned real estate and they're selling it.
Well, no, let me be more specific then,
Okay.
because there's no duplexes that are worth $15 million, or I guess in this case, $30 million. So what I'm talking about is from the syndicator who turns into consistently using DSTs as their strategy or a strategy to supplement their syndication business, right? Because you did say you can syndicate and then exit to a DST and continue to own and manage the property, but with just two different forms of ownership, you know, front end syndication, back end DST as a plan. But what have you seen typical path for somebody in apartment specific? It sounds like you deal with all the asset classes, and you probably have seen a lot more in industrial and other sort of commercial real estate. What about for apartments specifically? What kind of clients do you find that are buying these $40 to $60 million deals, and where did they start in the DST space?
So, I mean, I would say apartments make up roughly 2/3 of DSTs, maybe not quite that much. It's just an asset class that works really, really well in a DST. You know, maybe some people would argue with me, but I think the facts, and that's the statistics. You know,
Right?
Our managing broker, most of the firms we are working with are pretty large. We're working with Inland, Cantor Fitzgerald, Capital Square, Blue Rock, Pasco. I don't know if you're familiar with it, Hines, Ares Capital, Jones, Langs, LaSalle. I mean, we're working with huge companies, large. We're doing private deals with family offices. That's us. I have other syndicators. If you've got, hey, I'd like to do this as a DST and I've got a $10 million apartment and it's a good property, I can connect you. We're not going to do it and we won't sell it. We won't do anything, but I can connect you with another group that'll do these smaller deals for you.
Gotcha. That makes a little bit smaller deals.
We're dealing with my firm. We're dealing with the big dogs and the big money.
Yeah. I mean, you mentioned some names, and only JLL on that list is really buying in DFW at the top of the pack here, right? But I imagine like S2 and Tides and some of those is kind of where I was wondering if people that are doing maybe 50 deals in the DFW area, but are in that range, if they're starting to use this strategy. And I don't think any of them are, like Charlie Young, Madera, they're not using this particular strategy. But the question mark, I guess, is around, okay, if we're going to go a little smaller, are you seeing an appetite from your investors, right? Your people, even if we work with another company, a different brokerage, for, what is it like? Does it need to be like core urban or suburban? I mean, I know you might say, oh, it's just all in the numbers, but I'm really curious if there's something that you see stand out for those smaller deals where investors are like, I like this one. It's a little bit smaller deal, but I really like this.
I would say location is important. Like Cantor Fitzgerald, for example, they do a lot of deals in like the Chicago area. And I'm kind of like, I have no desire to invest in the Chicago area. I don't know the market, but I'd rather invest in Dallas or Tampa or Salt Lake City or Phoenix. for a lot of reasons. And at the end of the day, you know, I literally like, so for example, I think you could sell anything if it's a good property. But it's kind of funny. I would say 2/3 of the time, the investor just looks at me and goes, "Which one do you recommend?"
Got it. Yeah.
So I will literally show them my menu of, I think right now we have like 35 offerings available. I show them the menu and I'll be like, "Hey, I like this one. It's in, you know, Fort Myers, Florida." And I'll be like, "Oh, well, my wife cheated on me when she was on a girls' trip in Fort Myers, so I'm never going to invest in Florida." And I go, "Okay, we'll never talk about Florida again. Let me
It's a
show you this
bugaboo.
deal in Dallas." I mean, you get the weirdest shit from people.
The guy doesn't live in that building, okay?
Yeah, but you know, I literally just stop and say, "Hey, I'm not going to try to talk you into investing in Seattle, right? Like, I don't care. Whatever your objection is, I have a bunch of other options available. I'm not going to sit here and try to convince you to buy this." So I'm lucky in that, you know, we have a really big inventory. Some of these firms, there are a handful of firms out there that market directly to the public. And they have a harder time because they've got to convince investors to buy their offering. And sometimes your offer may not be a fit. You know, if the customer doesn't want debt or needs more debt than you have, that's sort of the weird part about the DST. It's hard to just sell the one offering. You as a sponsor, that's great because you'll still raise your capital because you're going to have a lot of people out there selling your product, and all these customers are going to have different needs. So, you know, there's a lot of moving targets to it. The 1031 market's a little more tricky because there's needs for it, right? You've got the debt replacement aspect, you've got the time issue aspect. You typically have an older, more conservative investor. They typically want cash flow. So, you know, it gets really tricky when I have a customer call me and say, "Hey, I'm at 63% loan to value in my property." And I go, "Oh, well, I don't have a property over 51% loan to value." So somewhere there's a gap in this exchange for the IRS purposes. I mean, it's a fairly, you know, not to get way out into the weeds, but I would definitely, you know, not every product is going to be for every investor. So it's important to try to get it. It's important, if you want to do this quickly, to try to get it with a group like us, or like I said, I can introduce you to other groups that can help you get the deal done.
It sounds like this is better for backfilling. I mean, the identify a property and go through this and to raise the capital. I mean, I don't know. It sounds like easier to, word easier, I don't
Get
know,
into it.
buy the property at the exit by backfilling it with this method. I mean, that's probably what, when you say, you know, Cantor, Fitzgerald, Hines, these guys are backfilling, they're buying them and backfilling them with DSTs money.
Well, I mean, no, the entire property is owned by a DST. They're not backfilling it.
Well, I mean, they own it in, they're, I mean, I guess I'm just identifying a property and then raising the capital this way. I mean, maybe I'm in the West Coast, our time, like, I just don't know the timelines in order to be able to achieve that.
So you got to understand. So like Cantor Fitzgerald, for example, they go buy the property.
Yeah.
They buy it in a DST, and then they're like, "Okay, well, we're basically, the money we paid for this property, we're paying ourselves back as we syndicate it."
Yeah, backfilling it. Yeah, exactly.
Yes, exactly. Back, or if they already owned it and decided to put it in the DST, yeah, I guess you are backfilling it. But these companies, they raise capital. I mean, Cantor Fitzgerald, you know, my firm's not the only group selling Cantor Fitzgerald, right? They've got financial advisors, you know, across the country selling their product. So they've got a very large sales force. Some of the firms we work with have a very small sales force, and sometimes those are the best deals. You know, some of these big syndicators like Cantor and Jones Lang LaSalle and Inland, I don't think their deals are always the best. I think they're so big, they just go buy shit sometimes.
They have to deploy a lot of capital, and it's kind of doesn't matter as much to them. Whereas we are a little bit more nimble to be able to find really good deals. But, you know, this is a balance of trade between this and just raising money as a syndicator the hard way. Yeah.
The nice thing is the permanency of capital. Like once you get those dollars in, then there's a high likelihood you'll hang on to those for a while through multiple projects.
Exactly. And as you add more projects, you start bringing in more capital. That's kind of the thing is, and doing your first deal is going to take some time. Like setting up your first DST, it could take you 6 months. But just because there's a lot of shit you got to do for the first one and get it going and understand the process. But once you do the first one, it changes to be much, much quicker to get it structured. I'm not talking raising the capital. I'm talking about getting set up to start the raise the capital. So realize that also on your first deal, it's going to take a lot longer than it will on your second through 20th deal.
Jared's totally right. Then for your first one, for this group, just with this group in mind, it might make the most sense then to syndicate or personally pay for whatever you got going on, right? But syndicate probably, and then backfill, because you can take your time. It's basically your exit strategy for a really nice property if you can syndicate on the front end, and then.
So for example, yeah, you could do your partnership deal. Let's say you syndicate a $10 million property. A few years later, it becomes you've doubled your money. You're ready to exit it. Well, you can exit it into your own DST if you wanted to.
What about this whole concept of you can't add value and it needs to be stabilized? What's very top of mind for me? Let's just take an actual example right now, right? 317 unit, great part of Grand Prairie. That is 2014, 1997 build, but classic interiors. So that classic interiors piece means you're probably deploying some interior CapEx when you buy and rehabbing, 80% of those. Once you did that, if you syndicated and you rehabbed all those 80 and you really boosted and you could exit, like it would make sense as an IRR for your syndicated portion. Is that the kind of property you could exit in a DST, or is that?
I would say have your syndication improve the properties and then sell it to the DST.
But is that too old, or It sounds
No.
like
Have it. No, we have deals that are older that have been, like 2014, but they made a lot of upgrades.
Okay.
It's upgrade it, then put it into the DS, then sell it to the DST.
Yeah. Backfill.
So do all your upgrades. You've got your growth. You're like, great. Hey, we've got an asset we're going to make some money on, but we still think this asset will appreciate in value and it's paying good cash flow. So let's sell it to the DST. This syndication, we can make our members happy and they can exit. And then now we've got it. This DST is a more conservative asset. It's a great strategy.
Bro, and then you can snowball that DST group, start buying brand new A class with that as it makes sense wherever, right? While also playing in the value add space.
Yeah. So your syndicators in your partnership are happy because you just doubled their money or whatever, right? And so maybe you're going to go find another syndication for them. Well, this is in the DST, and oh, by the way, now you've started bringing in a whole bunch of new investors.
Really cool.
And it can just keep going. You have to. There's a grand scheme and a massive vision here and a huge need. Like I don't know how many trillions of dollars. I forget the numbers, but most of the real estate in this country is owned by the baby boomers. They're all getting sick and tired of the toilets, tenants, and trash. And it's just the tip of the iceberg.
And those 1031 people might have non-1031 funds they deploy, I would imagine, because they know who the syndicator is.
You can do a cash investment and do a DST if you want. It doesn't have to be 1031. You can do a cash. The benefit of that is then you can 1031 out.
Yeah, so I guess that was another question that got answered, although I get where Brendan's going. Brendan's saying like, yeah, if you deploy, I know that for a fact. I just had to pass up on some 1031 money, over $1 million worth. And the guy was like, has never gotten to see me work as an operator. But if he had, then his $400,000 that he, made from his consulting business might get deployed on my syndications. Right. Because he's like, oh, this guy knows what he's doing. I don't need a 1031 with his 400K. I can take some of that in and just work in his current deals. So I get where you're going, Brendan. But back to the DST, you can come in if you don't have a 1031 on a DST. It just may not make the most sense, best return for your buck, but you're allowed to. that correct?
Yeah, I mean, I tell people, look, if you got a cash investment, a lot of times our different limited partnerships or REITs can be a little bit higher return because they can take more risk and do a little bit more with the money.
For sure.
But some people want that safe money. Some people just want to be safe. And the DST is a great option. And I want to mention really quick a little plug for myself here. If you guys have people calling you saying, I've got 1031 money and you can't take it, please refer them to me. I'll turn around and I will pitch them with their other money to try to get them to invest their other money with you. I won't try to sell them other products. I'll keep that arm's distance, but you'll look like a hero because you referred them to a guy to get them into a good 1031 property. I'll turn around and try to get them to work with you with the rest of their funds.
Consider it done, Ray. I like that
Yeah.
trade. A lot of sense.
And let me really give me 1 second here. Brandon, can I put up my contact QR here really quick? Wherever the
Yeah,
heck.
and I'll drop it
put
in
on
our
my
Facebook.
computer.
I'll
I'm
drop it on
happy. I
our
mean, we can
Facebook
still
as
keep
well.
answering more questions. You just made me think of something. So
Should have brought that up earlier. I mean, that's because we come across people with 1031 money all the time that may not, we don't have a deal, you know,
yeah, that's not it.
and it's got to go somewhere. Might as well go into a heavily vetted deal, you know.
Okay, why am I not finding my QR code here?
But if they have a short period to close, like somebody calls and they're like, I have to identify and close a property in 6 days and I got 1031 money, that
Mhm.
that they got to give you some
Yeah.
runway to be able to, right?
Well,
Not really.
Well, Ray said he had 51 at any given time. Like,
Oh, so you
one of
have
those-
ones-
one of those is bound to be closing soon.
So
Once it's in the trust, that counts, right? Like the clock stops on them. It doesn't have to have purchased the property yet. It just has to be in that trust. Is that right?
yeah, so the
Oh,
trust
yeah,
handles the
that's a good
property. So when
point.
they invest in DST, it's already a done deal. It's already set up. If they invest the very next month, they're getting their first distribution check.
When they're a timer, their countdown.
Well, I think Mike's making a good point, which I don't want to repeat something that he's not saying, but it sounds like, so what, that you have 45 days to identify, 180 days to close. Once
Right.
you move your money into the trust, let's say if they haven't closed that property, have you still fulfilled your closing because you moved it into the trust?
Yeah. Well,
I'm
like
being
I
unfair,
said,
I don't know if-
typically the DST is a done deal. It's already in place.
So I think
Oh.
more. Once they've identified. They've identified. They don't necessarily have to deploy that capital. So, but once they've identified, once Ray helps them identify, then they've met their required 1031 perspective, and then they can wait till closing. But once you close, that's what Ray's saying is it's part of the DST and they're getting paid the next month. So I think you're both right.
Yeah, so you can, for example, I've had customers name me as their backup plan. I just make sure that, hey, this deal is probably going to be sold out by the time you make your decision. So you might want to pick a different deal, right? Because once we raise 30 million bucks, we're not taking any more money. That deal's closed to investors. So from a backup plan standpoint, I tell people like, look, you can't really take your 180 days. You kind of got to do this. I mean, there might be a month or two leeway, depending upon how quickly the deal's selling. Like right now, there's a lot more time because just the deal flow is really diminished. So it's a lot easier now than it was 12 months ago to use DSTs as a backup plan.
Oh, there's just, I would think DSTs would be more active now because, well, from a capital raising standpoint, it's obviously probably a tougher sale to get new money to come into a deal where, to go out and sell a deal and have people give you new money seems more difficult than exchange money. And I guess, yeah, sales volume is down, right? People aren't exiting.
Well, that's my point. That's not the hard part. The hard part is buyers are backing out.
Yeah.
Like we're under contract. So, I'm going to wait 6 months now. It's a kind of a challenging environment for a seller right now. It's really a buyer's market all of a sudden. So
I like to hear that.
So, yeah, it's great for those looking to do deals where you're a guy like me who's really, dependent on people selling their property. It's a little bit of challenging of a market right now.
Yeah,
So,
sure.
Cool. Well, everybody grab Ray's contact information real quick.
yeah, please email me. I'd like to build. I know if you do click on the QR code and go to that, we will send you my partner's book. He wrote a book called "Are You Tired of Tenants, Toilets, and Trash?" And it's all about the DST. But I would love it if everybody would just email me their contact info. And, so I would say all things DST. Brandon, like, I don't know if you saw my presentation, but Ray is spelled DST. So anything DST, please call me. I'd love to help talk to you about if you have want to syndicate, or like I said, if you have somebody who just needs some help, please think of me.
Yeah, awesome, man. Well, I appreciate you taking the time to share your knowledge and experience with us today.
Yeah, I appreciate the opportunity. Great questions, everybody. And if you're still confused or have more questions, call me.
Thank you so much, Ray.
Yeah.
Thanks, Ray.
All right, guys, take care.
Take care now. Bye-bye.